Hello, my name is Dale Miller. I'm doing an MBA and a Master of Applied Finance. I also have a computer science degree from the early 2000s. I'm very good with computers. I'm considered a white hat hacker, which means I work for large companies doing large tests for them. And I also have a good interest in automation, particularly computer automation. I'm sort of an expert on it. So I've angled this report towards artificial intelligence trading. Um, let's see how we go. So what I've done is taken a look at the current trend at the increase in algorithmic trading on the markets, particularly in the US. I didn't want to just assume that it increased. I want to found some data that would support it, and it surprised me how quickly the algorithmic trading is increasing. If you have a look at the actual data, it's gone up quite a little bit over the last 5 years. This is with algorithmic automatic trading over here. The direct market access has also increased quite a lot as well, which is computers connected to the exchanges so they can trade faster. When I'm presenting this particular report, it's going to be from the point of view of a machine that's actually trading. So I've built a few algorithms before and know some of the advantages and disadvantages with computational trading. So a human trader, for example, suffers a lot of psychological issues, particularly when you're losing money. It's harder to think when you're losing money, basically. A machine doesn't suffer these problems. However, a computer can it struggles with self-organization. It doesn't understand knowledge in the same way that a human being does. It doesn't understand a human psychology. So you can blend the two, a human trading and machine trading, which is going to dictate the risk preference for this particular project. So what I've done is I've decided to have both a risk-seeking and a risk-averse preference, where the risk-seeking preference is for the machine trading, this being they can react much faster and are less likely to suffer from problems from media and things like that when they're actually deciding when they should trade. For the human trade, we want the long-term, more risk-averse approach where they want a portfolio that's going to follow a pattern that they're expecting. You know, the returns are a bit more expected, and the volatility, measured usually by the standard deviation, is relatively low. This leads us into the diversification, I'm going to call it a theory, where the more assets you put into a portfolio from various industries, the more likely you're going to diversify away the unsystematic risk or the firm risk of your portfolio. So the more different industries you have in your portfolio, the more closely correlated you're going to be with the industry market. That's the theory, and I'm going to try to prove that with the data, insight and statistics within this particular report. I also talked a little bit in the report about a recent experiment where I built a robot called Gold Watcher. It watched Newcrest Mining share price and the price of gold and alerted when the correlation was in a particular range. And it turned out that the trades were actually quite successful, so they did make some money over a short period of time. In comparison, the human trader myself made a bad call when the Banking Royal Commission was announced. I thought the current RBA head was very light in his speech, and I thought no one's going to really take this Royal Commission very seriously, and made a trade based on that. And the opposite happened. The Royal Commission is obviously very serious, and it was negative towards the stocks. So the two objectives that I've said are we want to see a risk-suitable profile, or portfolio I should say, for AI trading robots, but we also want to see a portfolio that's well diversified for the human fund manager, someone who wants to ensure he doesn't have to stay up every single night watching his portfolio. I noticed the Excel put effort in putting the percentage daily returns as opposed to the dollar sign returns, and that reminded me of statistics and having homoscedastic data and making sure your data is stationary. So I've ensured to follow the same format, and I've also included a graph showing the visual difference between the two. You know, you want a data set that returns close to the mean more often, as dictated by the red series there. The portfolio selection of shares into the portfolios. I've put focus on putting the gold mining, iron ore, banking, and then diversification. This is the injection order. It's not done accidentally. It's because of the before mentioned gold mining robot, as well as my own preference in iron ore mining. So I was expecting to see higher risk in the portfolio up to the 3 levels, but as we keep increasing the different types of assets, I was expecting the portfolio beta to decrease, as according to the diversification theory. So we did some execution, which took quite a long time using the Excel. I was very careful. I used the Excel format that was given, and the following statistics were found. I've highlighted the green for the more preferred, or I should say human preferred result, and the red for the more negative human preferred result. What we saw was, in this particular example, the standard deviation was a lot more for Newcrest Mining than it was for CBA. So we were noticing there was a lot more greens in the CBA, so they're better, or beta I should say, very closely with the market, and a little bit above the market as well, including the risk-free rate I think I've included. However, we see Real Mining Company, their beta is 1.55, so they're much more sensitive to the market than their CBA. So one's a banking sector, one's in mining, which makes a lot of sense when one thinks about it. The banking sector being able to react more likely to market changes by just changing interest rates, where Newcrest Mining, they're stuck, or Rio I should say, they're a mining company. Once they've made their investment, they're physically a lot more stuck than a bank. Also noticed the beta was very low for Newcrest Mining, which is very interesting. Well, it was interesting at first until you think about gold and how it's often used as a risk preference. So we see that Newcrest Mining doesn't follow the market as positively as the other assets that I've selected. It's very interesting for automated trading and probably can be taken advantage of. What I did was then continue to calculate and add those injection rate, and I was expecting to see the diversification theory, and I was pleased to see that it actually did. Excuse me. So what we noticed was the trend started to drift downwards, so the beta get closer and closer towards the market. So I'd say the market actual risk is set at 1, because that's the actual same as the market return. So we can see as we add more portfolios up to 10, we get closer and closer to this 1 mark, which means the diversification theory is in action over the last 10 years for the data that I've selected. So that was quite pleasing. In terms of the objectives, I want the riskier, excuse me, the riskier portfolio as opposed to the safer portfolio for the robotic trading. I've included the risk-free rate with the CAPM and I can graph those out as well. And you can see how closely some of the portfolios are related to the market return. So these results, in my opinion, were quite as expected. So it was nice seeing the diversification theory in play. The recommendations from this are, so for the automated trading, like I said, I would like to see the automated trading against riskier assets, so assets that humans tend not to like, or the more gambling type of humans like. I've noticed that the machine trading works well against those types of assets. So when the assets reach 3, which is Newcrest Mining and 2 of the other mining companies, we're seeing the most risk as expected. So I personally would be building 3 bots at least, monitoring those assets and alerting them back up towards a human trader. The second outcome was regarding a portfolio that was the least risky and the most expected portfolio to diversify most of the firm risk, and we found that as expected was the one with the most assets inside there at 10. That was to be expected, and that was actually quite pleasing to see in the results. From an AI trading point of view, you do want to build these robots that are based on 24-hour watching of the markets. When you add interoperational stuff, you can build many robots that all do similar things with the same functions, and you can react quite sharply to any kind of monitor changes, any kind of market changes. I understand a few large institutional banking put a lot of investment towards just fast computing, simply to get their order in a little bit quicker than their other very large banking counterparts. So in the future, what I'm hoping for Q2 is to include a recent, let's call it a firm or a trading firm that I developed called cashbots.com.au, which I want to include some of the robotics and some of the AI trading that I'm starting to research and get a little bit better at as I get towards the end of my Masters of Finance. So thank you very much, and I hope you enjoy the presentation and the report as well. Thank you.